right now, this exact second. While you're watching this video, America's national debt just grew by a few $100,000. It's adding roughly $8 billion a day. Not a typo, $8 billion every single day. The total? It just crossed $39 trillion. That number is so large your brain can't actually process it. So here's a way to try. If you counted $1 per second without sleeping, without stopping, it would take you 1.2 million years to reach 39 trillion. And yet, the US stock market is sitting near record highs. Treasury bonds are still considered the safest investment on earth. The dollar is still the world's reserve currency. That contradiction is the entire story tonight. Because normal logic says, if a person borrows more than they could ever realistically pay back, they go bankrupt. But a country, apparently, doesn't play by that rule. And until you understand why it doesn't, you have no idea when this system actuates. This isn't a trivia fact. This is the engine underneath your mortgage rate, your savings account, your job market, your retirement fund. Every time the Federal Reserve raises or cuts interest rates, it's wrestling with this debt. Every time you hear about a debt ceiling crisis in Congress, that's a symptom of this exact machine. And right now, in 2026, the pressure is higher than it's ever been. America's debt to GDP ratio, debt compared to the size of the entire economy, sits at roughly 123%. That means the country owes more than it produces in an entire year. Interest payments alone, just the cost of servicing this debt, not paying it off, now eat up about 14% of the entire federal budget. That's more than the US spends on national defense in many recent years. So here's the real question hiding underneath all of it. Is America actually broke? Or are we using a definition of broke that simply doesn't apply to a country with a printing press? Let's start with the basics, because this is where most explainers lose people. When the government runs a deficit, it means it spent more than it collected in taxes that year. To cover that gap, the Treasury sells bonds. A Treasury bond is basically an IOU. You hand the government money, and they promise to pay you back with interest, sometimes in a year, sometimes in 30. So who actually buys these IOUs? Banks, pension funds, insurance companies, foreign governments. Japan and the UK are currently among the largest holders. And here's the part that changes everything. The Federal Reserve buys them too. When the Fed buys government bonds, it's effectively creating new money to do it. This is why people say America can just print its way out of debt. And technically, that's true. Unlike Greece during its 2010 debt crisis, which used the euro and had zero control over its own currency, America controls the dollar completely. It can print more, which means an actual default, where the US simply can't pay, is almost impossible, unless it chooses to. But that raises the real question. If you can just print the money you owe, what does broke even mean anymore? This is where it gets uncomfortable. Printing money isn't free. The cost just doesn't show up where you'd expect. It shows up as inflation. When more dollars flow through the economy, without a matching increase in actual goods and services, each individual dollar becomes worth a little less. It's a tax nobody votes on. No bill gets passed for it, but it shows up on every grocery receipt. The inflation spike of 2021 through 2023 wasn't just a supply chain story. It was, in large part, the direct consequence of trillions of dollars printed during the pandemic finally working their way through the system. Now stack a second layer on top of that: interest rates. When the Fed raises rates to fight inflation, the government also has to pay more interest on its own new debt. That creates a loop. More debt, higher interest costs, more borrowing just to cover the interest, even more debt. The average interest rate the US now pays across its total marketable debt sits around 3.4%. 5 years ago, it was about 1.5%. That means the cost of carrying the exact same debt has more than doubled, without the government spending a single extra dollar on anything new. And here's the irony. Nobody puts on a headline. America is now borrowing money specifically to pay the interest on money it already borrowed. It's paying off one credit card with another credit card and calling it fiscal policy. The hyped version goes, "Don't worry, America can always print its way out." The reality is messier. Yes, the risk of an outright default is close to zero, as long as the debt stays denominated in dollars. But there's a different risk that doesn't get nearly enough attention: trust. The entire system runs on one assumption: that the rest of the world keeps believing in the dollar and keeps buying treasury bonds without hesitation. The moment that trust wavers even slightly, investors demand higher returns to keep lending. Interest rates climb, and the debt becomes even more expensive to carry. This isn't theoretical. Major credit rating agencies have already downgraded America's credit rating in recent years, something that had essentially never happened in modern history before this decade. And there's a second, quieter reality check. This entire system only works smoothly if the economy grows faster than the debt. But when interest payments alone consume this much of the federal budget, there's simply less room left for things like infrastructure, research, and education. At that point, technically not broke starts to feel like a hollow kind of victory. Because the real question was never whether America will default. It's how much is actually being sacrificed just to maintain the illusion that everything is fine. Zoom out far enough, and this stops being just an American story. The entire global financial system is built around the dollar. Oil pricing, international trade settlements, central bank reserves around the world. Almost all of it is denominated in dollars, which means when America prints money, it's not only Americans who absorb the cost. The entire world quietly shares that inflation tax. That's exactly why countries like China and Russia have spent years slowly diversifying their reserves, buying gold, exploring alternative currencies. It's not some grand conspiracy. It's a slow hedge against a system that everyone privately suspects can't expand forever. The long-term risk is simple to state and uncomfortable to sit with. If interest costs keep growing at this pace, within a few decades, America could be spending more on interest payments alone than it collects in total tax revenue. At that point, there are only three real options left: raise taxes, cut spending, or print even more. The third option is always the most politically convenient. It's also the one that keeps the entire inflation and trust erosion cycle spinning. So no, America isn't technically broke. The odds of an outright default are close to zero. The system is working right now, but working and sustainable have never meant the same thing. Every financial system in history that eventually collapsed said the exact same thing the day before it collapsed. It's still working. So the real question isn't whether America defaults tomorrow. The real question is when the rest of the world finally decides that unlimited trust in the dollar is no longer safe. Will we still be telling ourselves the system is working? Or will we have started asking, long before that day, how much longer it actually can? Multiple economic studies, including research from the Federal Reserve, have found that this dynamic effectively transfers wealth from lower-income, cash-paying households to higher-income households that use rewards cards. It's not a side effect. It's baked into the structure. And here's the irony that never makes it into an ad. The customers who are the most financially disciplined, the ones who pay their statement in full every month, without exception, have an actual name inside the industry too. They're called deadbeats. Not as an insult you'd hear out loud. It's literal internal terminology. Because from the bank's perspective, a customer who never pays interest is the least profitable person they have. So paying your bill responsibly, in full, on time, every single month, the exact behavior every financial advisor tells you to practice, earns you the industry's least flattering label. That's not a coincidence. That's the business model working exactly as intended. Now step back and look at the entire machine from above. Interchange fees guarantee income on every transaction, whether you carry a balance or not. Interest generates the real profit, concentrated on people who are financially stretched. Late fees and penalty APRs add another layer on top. And rewards programs keep the most profitable customers, the highest spenders, locked in and loyal, even when better options exist. This isn't a small business. In recent years, total U.S. credit card debt has crossed $1.1 trillion, and interest charged to American households has hit tens of billions of dollars annually. Money extracted almost entirely from people carrying balances they can't fully pay off. And here's where the long-term risk starts to show up. As household debt grows, spending starts to detach from actual income. The economy can look healthy, retail numbers up, consumer spending up, while what's actually happening is that a growing share of that spending is borrowed, not earned. We've seen this movie before. The 2008 financial crisis wasn't caused by credit cards, but it revealed the same underlying principle. When a system is built on people spending money they don't yet have, the system looks fine, right up until the moment it doesn't. And right now, in 2026, credit card debt and delinquency rates are climbing again, not primarily because people are buying luxury items, but because more Americans are using credit cards to cover groceries, rent, and emergencies in an economy still adjusting to years of inflation. A tool that was marketed as a convenience has quietly become, for a growing number of people, a survival mechanism. And the interest machine underneath it keeps running exactly the same way, regardless of why the balance was created. So we're back to that thin piece of plastic sitting in your wallet, light, unassuming, practically weightless, but every time it gets tapped, it quietly pulls money from 3 different directions at once, from the merchant, from the cash-paying customers standing behind you, and from anyone who carries a balance a little longer than they meant to. And the most unsettling part of all of this is that nobody has to cheat for it to work. There's no fraud here, no illegal fine print. This entire system is completely legal, fully disclosed, sitting right there in a cardholder agreement most people will never read in full. So the real question isn't how banks make their money. At this point, that part is obvious. The real question is this: if an entire multi-billion-dollar industry is engineered around the assumption that ordinary people will be a little forgetful, a little late, a little too optimistic about paying things off next month, then how many of the choices we make with our money are actually choices at all? Or has someone else already decided how we'd behave long before we ever picked up the card?